Okay, we are going to start. Take your seats. Okay, should we start? Please take your seats. I am, trying to record this session now, and we'll share you a recording. Okay, fine. Sometimes the recording doesn't go well, but let's see. I've been using the software called OBS. Are you familiar with this? You can record your, this thing. So of course I have Camtasia also, which is a little more professional, but this has been a free software, and I am recording this on a mic. So the recording is separate, the voice recording and the audio recording, and merge it and share it. Okay. Because if I move here and there, then the recording will not be captured by, my voice will not be captured by the laptop. This instrument captures my voice so that I can just remove the voice of my laptop speaker and then impose my own voice on the video. Okay, I'll have to do that. Okay. Fine. And just always, see that there is a red sign here. That means the recording is on. Okay. Sometimes we start the lecture and we don't the button, so it will not be recorded. But I've got two, classes separately, so somewhere it will get recorded. So there is no problem. Okay. So I've just shared, a file on your WhatsApp. One is called the average market capitalization, which I shared. The one was called something valuation. Okay. Somebody asked me, how do we calculate the growth in EPS? Who asked me? You asked. So this file is going to help you. I'm just going to show you for a while. Okay. So this was, the valuation course which I did last semester. So, this is this we did for the paint industry. Okay. So if you look at here, we have how many companies are there in the paint? This thing, Asian Paints. Okay. Then we have Berger Paints, Narrow-Dak, Asgo Noble, and Indigo Paints. So all the other companies. So students were asked to, make a project where they can put their own companies of the industry they want. Okay. Put the, the price, share price. So all this information you put. Okay. And then, the growth in earning per share. So what I wanted to say was, find the growth from the trading view or many softwares they contain, how the company is going to grow in future. So put the numbers of EPS against each company. And then there's an average growth which is coming here, 14%. Okay. Then I remove the sign of the percentage sign and then calculate the PEG ratio here. So this is the growth and the PEG ratio has been calculated here. Okay. So then we say that, the Asian Paint is trading at 4.49 PEG ratio, which is much higher. It's trading at a huge premium to its growth. And in fact, the median itself is 5.3. So all the paint companies have been trading at a very high, lofty valuations. Okay, fine. So this is just for your understanding. Nothing. So I'm just closing this. So let's start with our main listing. So this is what we started, financing large projects, and there's a case study which we'll be doing today, little bit. So we did the definition, okay. So as we know that it is a a project which involves huge capital, it takes a lot of time, okay, to construct the plant, and there are multiple stakeholders, okay. As we know, a lot of stakeholders like the EPC contractor, O&M contractor, off-take agreements with the customers. So these are all the stakeholders now, we understand that. Then there is a predictable long-term cash flows. Okay, fine. Then, these were some of the examples, and we did the key characteristics. Okay. And then, I'm not repeating, project finance and corporate finance. Okay. Now, there are two kinds of finance. One is called the project finance, another is called the corporate finance. A company can take loan, or a company can take a loan for its project. Okay, there are two kinds of finance, project finance and corporate finance. So first we talk about project finance, the topic which we are going to understand, and then we move on to the corporate finance a little bit. Just read. You were reading? Up, Padi.
Project finance definition. Finance is a financing technique where funding is raised for a specific project. Repayment depends on project cash flows. Assets and contracts of the project are the primary security.
So is that okay? So it is basically just to that project, and fund is raised for the specific project, and repayment of the loan is made out of the cash flows from the project. Assets and contracts of the project are the primary security. So if there is anything goes wrong, then the lenders have the recourse on the assets of this company or this company to whom they have given the loan, and it is in the form of an SPV, a separate company. Okay. Then we have the corporate finance, where the corporate raises money for various kinds of businesses. Okay, just read.
Corporate finance involves financing the entire parent company supports borrowing.
So here basically it's called the corporate finance, where the corporate is raising a loan for managing its businesses. Okay, it can be deployed in on in their business. Okay, and for financing, they may have various businesses, and the debt is repaid overall company's cash flows, not from the project. Okay, and the balance sheet of the parent company supports the borrowing. Okay, fine. So this is a general kind of a finance where the promoters take the money for running their business, and they may have a conglomerate or various kinds of businesses. They buy assets. Of course, when they take the loan, they always go to the bank and approach whether this loan is for their working capital requirement or for asset buying. So they have to give all the information. But the bank, the borrower, can have a recourse, from the company. Suppose the particular business is not doing well, but other businesses are doing, so the cash generated by other businesses can be used for repaying the loan of the bank, despite the project from which the loan has been taken is not able to generate cash flows. Have you got the difference between the project finance and a corporate finance? Okay, we'll have some more definitions coming in. The key definitions or key differences. Okay, read.
Borrower, in case of project finance, SPV, and in case of corporate finance, it's operating company. Recourse.
Okay, first, the borrower has to be an SPV in case of project finance, a separate company which has been formed for a particular project. Okay, so that basis itself, actually puts a limit on the lenders. They have recourse only on the SPV assets and not at the entire assets of the company. Then the corporate finance, who is the borrowing? The operating company, the company which is operating the business. Okay, next.
Recourse in case of project finance, limited or non-recourse. In case of corporate finance, it's full recourse.
So they have full recourse in case of corporate finance. The loan has to be paid by the balance sheet of the company from whatever businesses they are generating the cash flows, not particularly from for the job they have taken the business for a project. But in case of a project finance, there is no non-recourse. Okay, limited or non-recourse. Limited because the liability of the sponsors are limited. Okay, fine. And there is a non-recourse. That means they can't sell the assets other than the assets of the SPV for fulfilling the loan obligations. Then and they have full recourse in case of a corporate finance. Is that clear? Then we have the risk.
Risk in case of project finance, ring fenced to project. In case of corporate finance, spread across firm.
Okay, to understand what is the ring fence, just see the bottom. Ring fenced, the project cash flows, assets, risk and liabilities are legally isolated from the sponsors, other businesses and finances. So it's all ring finance. That means all the assets of only the SPV would be liable to pay the dues of the sponsor. Only the cash flows which they are generating, they will be only helping to pay the loan liability of the company. So it's a ring finance. Okay. Whereas in case of a corporate finance, it's spread across the firm. Okay. The risk is other businesses are liable if they are generating huge income, so they have to fund the particular business which is not doing well, even if the company has taken a corporate finance. Then, yeah.
Security in case of project finance, project assets and contracts. In case of corporate finance, it's company assets.
So all the balance sheet of the company, all the assets of the company will be dragged in case of a corporate finance, whereas in case of a project finance, it is the project assets and contracts would be liable. The contracts, we have an EPC contractor who is liable. The risk is shared by him. O&M contractor, he's sharing the risk because he's going to maintain the project, and it has to deliver, the production performances based on the specifications set by the company or the sponsors and agreed by the O&M contractor. Similarly, a engineering company or EPC company like Larsen Tubro, they produce assets and they give guarantee that how much it is going to produce. So and it has to be done within a time limit. There can't be cost overruns. It has to be, the time has been set. If it goes beyond, then the EPC contractor pays the liability or bears the risk. Okay. Then
complexity in case of project finance is high. In case of corporate finance is moderate.
So it is high because there are a lot of contractual obligations that are with them. So it's having a more agreements driven kind of a business. Okay. Typical use.
In case of project finance, it's infrastructure, energy. In case of corporate finance, it's manufacturing services.
So, basically the project finance is for infrastructure businesses or energy businesses. I'm setting up a park, I'm making a highway or a road or a toll or whatever. So it is for those kinds of particular projects. Whereas in case of a corporate finance, it is for manufacturing, normal manufacturing, okay, or for, producing services and selling services. It's for the entire business of the company. Is that okay? Any questions here? Okay. Now, why project finance is being used?
It allows risk sharing, protects sponsor balance sheets, enables very large projects, attracts diverse funding sources like banks, DFIs, and governments.
Okay, just hold on. So, attracts diverse funding sources like banks or, the DFIs, which are basically institutions. Okay, we'll talk about them. Then we have the stakeholders and transaction participants. So, who are the stakeholders here and who participate in the project? So, first is sponsors, the person who is going to run the business, who is going to take who is going to provide equity. Okay, bring the equity capital and be responsible for the project. They are the developers. Okay. Okay.
Project promoters, equity investors.
So they are the project promoters. So they are the promoters of this project. They are going to provide the equity for the business.
May include infrastructure companies, energy developers, government entities.
Okay, so they are normally, in the case of infrastructure businesses or energy, businesses, developers.
They provide equity capital, guarantees during construction, strategic oversight.
Okay, so they provide equity capital, they guarantee during the construction, guarantees during the construction. Okay, sponsors like the parents of the project, they invest first and take the maximum risk. Okay. Then the lenders, the second stakeholders are the people who provide loans. So equity providers are basically the SPVs or the sponsors, and then or the developers, we can call them by different names. And the second is the lenders who bring in debt, who bring in loans. So they are basically, the commercial banks, development financial institutions, DFIs, bond investors. Now, a company can raise bonds. Okay, company can issue bonds, debenture, convertible, non-convertible debentures, so people can subscribe, and company gets money. Okay, so the focus is on cash flow stability. So they focus on cash flow stability, risk mitigation, and debt service coverage ratios. So these are the three things which are looked by the lenders. First, is there a stable cash flow? Are the customers have the contracts with them. Like I said, there can be 30, 40 years of contract for buying the output of the business. So the lenders are sure that the company is going to generate huge amount of cash during the life of the project. So there is a cash flow stability. How is the cash flow stability? We're going to look at that. If the cash flows are stable, so they are assured that the lenders can give and finance the company. Then risk mitigation. Has the company, done the risk mitigation? That means the risk has been passed to the EPC contractors, O&M contractors, Okay, so all risk has been been taken care of the company. Well, all the agreements, so they are going to look at the agreements. Okay, the loan appraisal is done, they are going to understand and look at the agreement with each of the operator to see that the risk has been mitigated. So if the risk is fully mitigated, then they are ready to lend, and they find that the project is worth lending and it is a good project where they don't have any fear of losing money. Debt service coverage ratios, that's very important. Debt service coverage ratios. Okay, have you know about what is debt service coverage ratio? So of course, like for example, okay, we'll say here only. So debt service coverage ratio is how much cash the company is going to generate divided by the principal and the loan. The principal plus the interest, how much the company is going to pay on the loan, and what is the total amount of cash the company is going to generate. Okay, fine. So if the ratio is more than 1, 1.2, 1.3, the more it is, better it is. If the debt coverage ratio is 1.5, so that means the lenders are sure that they have a lot of cushion. Okay, so it will depend upon industry to industry. So whenever the banks lend money to various projects, they look at the projects. Okay, like for example, a solar power, a 1.3 DSCR ratio is okay for them. Suppose it's a telecom project or any other project, so they say it has to be 1.6 or 1.4. Okay, so the ratios are set by the banks, and we're going to talk about them little, what is the logic and how it is done. So there are different DSCR ratios related to different kind of businesses. Okay, so if it is a solar power project, a 1.3 ratio would be good enough for the lenders to give finance to such kind of company. Okay, then okay. Okay, I've just opened the wrong file, so that's why I was thinking that I am not getting. That is a backup file which I opened. Okay, so this we have done. Okay, now we know that the risk is actually distributed through context. Okay, so just read.
In project finance, each major project risk is allocated to the party best able to manage it, and this allocation is legally enforced through contracts. Banks lend only after risks are clearly allocated and contractually mitigated.
Okay, so the banks are going to only lend once the risk mitigation process is completed. Okay, so let's understand what is that. So the first risk is the construction risk. Okay, read this.
The risk is cost overruns, delays, poor quality, allocated to EPC contractor. If construction is delayed or cost rise, EPC contractor bears the risk, not the SPV or lender.
Is that clear? Because there is going to be a construction risk. Okay, so you are going to allot the job to a EPC contractor, companies like L&T and other companies. So we can just look at the various companies which we have in India who are going to take the risk. So this is if you look at the peer chart here. So these are the various companies. Okay, some are purely EPC companies, some are government EPC companies. So they are all together 116 companies in India which are doing this job. So the namely like Larsen Tubro, which is having the biggest company in India. Then we have the Rail Vikas, NBCC, then Kalpatru Projects, KEC International, okay, then Ircon International. So there are various companies which are actually doing the job as working as a EPC contractors and taking the risk of the construction, procurement and engineering part. So any questions here? If the construction is delayed or the cost rise, EPC contractor bears the risk and not the SPV or lenders. So the first risk is taken by the EPC contractor. There will be no cost overruns. If there are cost overruns, they are going to bear that risk. If there are delays or poor quality of of the project, then they are going to either correct it or bear the losses. If they are going to again redo the job, so that they bear all this thing. Then the operating risk. Once the asset is made, then the asset is being used for producing the output. So this is managed by the O&M contractors. So read please.
Risk, poor performance, high operating cost, downtime allocated to O&M contractor, stable operations, then predictable cash flows, then lender comfort.
Okay, so the poor performance, high operating cost and downtime. Okay, so all this risk is taken by the O&M contractor. So if the costs are higher than what was actually earlier agreed between the O&M contractor and the SPV, the extra cost will be borne by the O&M. So it is because of either a high downtime or whatever this thing quality is not being properly being manufactured. So they are going to bear the cost. So downtime, do you understand? Downtime? The downtime means because if the plant is being set up, it can't run at 100% capacity all the time. Like a solar project, the typical capacity utilization is only 22%. Because all the time there is no sun. Sun is only for a limited time. So it can only produce a certain portion. It can be the capacity would be far less than 100%. Okay, like all your plant and equipment, there would be some kind of a downtime, maintenance downtime or annual maintenance downtime. So the plants operate at almost like 95 to 90% depending on what kind of asset it is. So they don't run at a certain capacity. There has to be a certain normal downtime, like a 5% or 10% downtime. So if it deviates, if the downtime is more and the company is losing money amount of that, so O&M contractor will be responsible for that. Suppose the downtime was agreed that will be running at 90% capacity and all the downtime is taken care, 10% there will be a downtime, but if the downtime happens to be 11% and the company is losing output, so that the loss will be borne by O&M. So he has to make sure that the company plants and equipments are properly maintained and they produce the desired level of output. If there is a deviation, then these contractors will be responsible. Okay. So this would mean stable operations, predictable cash flows, and lenders will be at comfort. They know that entire risk is being taken by the two people, the O&M contractor and the EPC contractor. First, EPC contractor during the formation of the contract, and after it is handed over and given to operation and maintenance contractor, he is taking the risk of that the plant and equipment has been properly been maintained. Okay, and it is producing the desired output. Then we have the revenue and demand risk. Now again, the revenue is also tied up by the company by entering into an agreement. Okay, like a PPA agreement, power purchase agreement with various bodies in case of a power project, allocated to off-taker. Power purchase agreements, it's called PPA. Revenue becomes contracted, not market driven. So you're doing a business, it's not that what will be the market and how will be the demand. So if it is there is no long term this thing, so the lenders would hesitate. So here the lenders are very comfortable. They know that the off-takers have actually entered into an agreement and they are going to buy the output of the company for a long period of time. Okay. Now, but of course, like power purchase agreements, like the power is being purchased by what? By the electricity boards, and they are not very AAA rated companies. They default because they are running into losses. Okay, they are not doing a very good job in India. So there is a risk also involved, but that risk is totally different. But they are going to buy the power. Okay, so then the company is going to have some kind of agreements to make sure that they don't default. Okay, if they default, then they have to pay it. By if the government has to support them, or from whatever source they need to repay it. Okay, fine. Or sometimes maybe happen that instead of paying regularly, they will be paying after 3 months, 4 months, along with the interest, but they pay. Okay, like in the case of the Reva project, it was being sold to Delhi Metro Corporation, which is a AAA rated company. So almost say 50% of power is purchased by them. So lenders are very happy that they won't have any default kind of a situation coming from the Delhi metros. Okay. So revenue and this thing. So in project finance, risks are not avoided; they are contractually reassigned. Okay. So in a project finance, so the risk is assigned to various bodies. So lenders are at comfort. They know that there's a steady revenue, and they are going to be paid from the cash flows which the project is going to generate. Risk. Okay.
Risk: inability to service debt allocated to sponsors limited and lenders structure. Debt sculpting, designing the loan principal repayment schedule so that debt repayments closely match the project's expected cash flows, ensuring stable DSCR over time.
Okay. Now, since you have everything tied up, your customers are there, all your O&M contractors are there, there's steady cash. But it can happen that the cash flows, pick up over the time. Initially to start with it's less, but then it picks up. So the cash flows are not, the cash flows are there, but the banks can, sculpt they can first of all they can size the loan. How much loan can be paid based on the revenue being generated by the company. Okay, fine. If they say that DSCR ratio has to be 1.3, based on that ratio, they are going to fix up the loan. How much loan they can give to the company. Okay, and then they are going to spread the loan in such a way that the cash flow generated by the project in the life of the project, they are able to repay the loan. Suppose the loan is for 10 years or 12 years. So into 10 to 12 years, they are going to spread the principal and interest in a way that it is paid out of the cash flows generated by the project. The cash flows can be uneven, so they will design the loan in such a way. It's called debt sculpting. Okay, and we'll understand that. And there's a revenue model. There's a model where you can find how much maximum the loan can be given and how the debt repayment. It's all Excel-driven formulas where when you will be doing the project, you will be using those Excel sheets to size the loan and then spread the loan. I'll just see if we can show a little flavor of that, but we will be doing it that much later. So here, this is one of the model where you will be putting all the parameters that the debt is for 12 years and rate of interest, what the lenders are going to charge, and what is the target, debt service coverage ratio, okay, and what is the discount rate which you are going to use, that is basically the interest rate, okay, and debt amount. So it will give you the debt amount automatically. If you put all these numbers, the first three numbers, the loan amount will come automatically. So this is an Excel-driven formula where the loan will automatically get populated. Okay, and if you look at, these are basically the cash flow is the company. I'm just going to just little bit explain. We are going to do it much better in our coming classes. Suppose there is a project, okay, which is going to generate. These are the cash flows. Okay, first year cash flows, second year cash flow is called cash flow available for debt service. Okay. So CFAD means cash flow available for debt service, which means how much company is earning in form of EBITDA minus the working capital requirement minus what? Minus the what all? The couple of things minus the tax. Okay, fine. Minus the working capital. There are three things. I'm just forgetting one. So you get a CFAD. That is the cash flow available for debt service. Okay. So this is the cash flow available for paying the debt. Okay. So the company has calculated that they are going to generate this much of cash flows. Okay, for the 12 years. Fine. Then we put the inputs. What is the term loan? How much year the loan has to be paid? What is the interest rate? And what is the debt service coverage ratio, which is the target one? The bank says that we will lend only at 1.3. Okay. So and then we come to arrive at the debt amount. How much debt the lender can pay? Okay. So so this is called the debt sculpting, where automatically this figure will get populated here, 197 from the input sheet. Automatic, it will go to the sheet, and then it will decide the total debt service is 1.3. If you look at 1.3, okay. So the CFAD, look at the debt service is equal to CFAD divided to the target, DSR at the top, this thing. So you find it is 23, okay. The company is generating a CFAD of how much? 30, whereas this is total debt service is going to be your 23.08. This is the maximum, 1.3, okay. So it has been back calculated, and then the interest is calculated at the interest rate, and the balance goes to the principal automatically. प्रिंसिपल तो पता है, इंटरेस्ट तो हमें पता है कितना देना है, जो बाकी होगा वो प्रिंसिपल रिपे ऑफ हो जाएगा. Okay, so the closing debt balance. So like this, you will find at the end of the 12th year, the figure will become automatically 0. So what it does, it takes the targeted ratio, calculates the loan. First of all, I'll show you how it has been calculated, and then it makes a schedule, amortization schedule. How much principal will be paid, how much interest will be paid. Interest, we know it is 9% of the loan amount. Okay, so it is putting that amount here. Interest is coming here. Okay, so it is B3 inputs into B4. So B3, if you look at B3 is this thing, and 9% rate of interest. Okay, fine. So on that basis, it has just calculated that, and ultimately it will come here. Then the loan, the CFAD is 30 crores. We know that every year 30 crores the company is generating, and debt service is been calculated based on the ratio, DSR ratio. Okay. Then what we do is we discount all the CFADs, because we want to know that how much cash the company is going to generate today. What is the present value of the cash? Okay. The company is going to take 12 years to generate so much of cash. We are going to calculate the present value of that. Okay, fine. Then present value of debt service. So this figure will be 1.3, which is being calculated by using a formula here. Sorry. Okay, so here I'm just it has been done like this. Okay, so I just gone actually a little bit ahead, so that's why I should have covered it a little later, but would have explained you everything. But anyway, we'll cover this more in detail, just a flavor today. Okay, fine. So what we are doing is basically we have calculated the present value of the CFAD, okay, which is 27.25, because this cash flow is being generated in the first year. So what is the present value as of today? So for each present value of all the years, and then the present value of the debt service, how much interest and principal the company is going to pay, and then we calculate the loan life DSR ratio. Entire loan life, what is the debt service coverage ratio, which is the target coverage ratio. So the bank says that we are not going to just rely on the first year DSR ratio, we are going to calculate what is your loan life debt service coverage ratio. So what we do is we take the present value of all the cash flows that the company is going to generate for paying off the loan, and the loan also present value, and then we calculate the debt service coverage ratio, which is 1.3. Okay, now this 1.3 is used to calculate the loan size and the debt amortization schedule. Is that okay? So if you just go here, so you will find that, So this is the last summary where it says the debt has to be 197 crores. The 197 can be given to this company based on the cash flows which the company is going to generate. The company has given the cash flows. Okay, this is the cash flows. The bank says this is the rate of interest. Now the bank decides how much the maximum loan it can give and what will be, how it will get repaid during the entire 12 years based on the cash flows being generated by the company. So this Excel sheet, which is a formula driven, I've shared it. Have I shared this? I'll just share it. Okay, fine. So so this is the maximum this thing, and then 1.3 is the debt service coverage ratio, and the closing debt is 0. So this formula says that it has to be 0 all the time. If you get a 0, that means you've done a good job. All your loans are getting amortized during the entire 10 or 12 years. All the cash flows are being taken care. All the formulas are working. Suppose you don't get a 0 here. Okay, fine. So then you have to use a goal seek function. Okay, like you can go to a goal seek function, go to the data and goal seek function, and then you say that this value has to be 0 and this value should be this the reference value will be this loan amount here, this amount. Okay, so it will make automatically 0. So we'll do that later on. Okay, fine. So because this was not part of the today's agenda, so that's why we will do it maybe next few weeks. Okay, when we reach to this point. Okay, let's go back. So the financial risk. This was just basically why I told you, I just wanted to make sure that you understand what is written in the slide. So I had to move a little bit fast forward. It requires, a full explanation of the model and everything. I tried to, I think I've tried to explain that, and I think you have got something out of it. Okay. So now just read this slide in your mind again. Just read. Is it making sense? Is that okay? So the bank knows that this is the debt service coverage ratio. I'll give you so much of loan, and it will get repaid during the course of the project, during the course of the loan, tenure, and so that the banks find that the DSCR ratio is been maintained throughout the life of the loan. Okay, which was 1.3. So with that, the company was able to pay the loan without any problem, because the loan was being paid out of the CFAT being generated by the company, and they were not evenly distributed over the time. Okay, so this Excel sheet will make sure how much the loan the company can be paying, the sizing of the loan, and then the debt sculpting. That means how the debt will get amortized over the life of the loan. Is that okay? Okay, now look at the last two. Sponsor, the loss is usually limited to their equity investment. Okay, because the financial risk allocated to sponsors is limited. How much money they have put, they can only lose that much of money. Suppose I am a sponsor, I put 1,000 crores, maximum loss I can make is 1,000 crores. Sorry, मेरा पैसा निकल गया. The project could not do anything. This is the maximum loss I can. It's a limited liability. No other assets of the sponsors, other companies will get involved to be repaying the company's loan. Then the banks take risks but protect themselves using the DSCR ratio and LLCR ratio, loan life coverage ratio. Now the DSCR ratio is for the one single year. Okay, fine. अभी का CFAT कितना है? अभी की आपकी debt payment and principal payment. So if you can divide that, you will get the particular year's DSCR ratio. Okay, but if it has been, we have calculated the LLCR, which is the loan life coverage ratio. Okay, then the reserves. Now what happens is that if suppose the bank thinks that the company company has to make a reserve. Okay, whatever loan which is going to fall in the next 6 months, company has to make a reserve. Keep the balance separately in another bank account, which they can't use it, which can be only used for repaying the loan. So that's called the reserve. So we'll talk about that in detail and so this is called the reserve. So the companies need to make a reserve. So the next 6 months, every year that reserve needs to be managed depending upon what is the debt service, total debt service they have to make. Okay. So this is their requirement. It's a bank balance. In a balance sheet, it will be shown as a bank balance, but the company doesn't have any recourse to the cash balance. It can be only used to repay the loan of the lenders, not for any other purpose. Okay. Then we have the agreements. All the covenants or the agreements will also protect that they have a recourse towards the EPC contractor, they have a recourse towards the O&M contractor if something goes wrong. Okay, they can sue the EPC and take the money from him for any loss occurring because of the bad, the machines and equipments being, produced by the EPC contractor, or if the contracts are not been properly, maintained and serviced, the machines. So if there is any loss, so the banks provide all those agreements in the clauses so that they can step into the shoes of and take money from, or risk is getting reduced because of that. Okay, just read this.
Risk allocation in project finance refers to the contractual distribution of project risk to parties best able to manage them, thereby protecting project cash flows and improving bank ability.
So risk allocation in project finance refers to contractual distribution of project risk to parties best able to manage them, thereby protecting project cash flows and improve bankability. Now the banks can give loan only if the project is bankable. If that all these things the bank feels comfortable and they can provide loans, it becomes bankable. Bankability is provided to that loan. Okay. Now just read it. All of you can just read it because we have already covered. This is a summary of what we have done. So are you ready? Just when you are ready, just let me know so that we can move forward. I'll pause for another 2 minutes. Okay. Just read it. If you have any questions, you can ask. Have you understood so far? Is this subject interesting or boring? Interesting, hai kuch? Oh. So first when I saw this subject, because this is totally away from the subjects which I teach, which are valuations and stock markets, which are more interesting. Okay. So this subject was involving, a totally different. So I was just thinking whether students will like it or not. But I'm trying to make it a little bit more interesting by introducing a lot of other things also in the course. Okay. And there are a lot of practicals. Okay, because the questions will be all practical. In your exams, everything will be practical. Nothing, no theory as such. Theory will be just 10 to 20%. Is the optional part. Only some students find theory is a backup where you can't solve it, so they can even do theory also. Okay. Is this clear? Okay. Now, project finance and corporate finance. I think we did it. Okay. So the slide is repeating because I did it from the backup slide. Okay. So this also we did. Okay. Just read it. I think I added some, this thing. So full recourse. Just read this.
Full recourse means that lenders have the legal right to recover the loan not only from the project but also from the borrowers or the sponsors' other assets if the loan is not repaid.
So ring finance we have already done it. Okay. So this we have done. So this is like a pictorial diagram. There the corporate finance, the lenders give the money to the corporate. And in case of project finance, the lenders give money to the SPVs. Okay. ये भी कर लिया था. This also we have done. Okay. So here basically this was, so there was some here. off-taker agreements. I said that all your outputs have been already pre-sold at the time when the asset is made. So just read.
An off-taker agreement is a contract where a buyer commits to purchase the output of a project, giving lenders revenue certainty. The most common example of is a PPA.
The power purchase agreements, okay?
But there are several other off-take structures depending on the industry and risk allocation.
So PPA is basically used particularly for power projects, but there can be other projects like road projects and other things. So I just put something on this thing for the table, quick comparison table. So PPA, industry is power, revenue certainty is very high, risk of the project is very low because everything has been, the off-takers have taken entire production for the entire life of the project. Then we have the GSA, which is a gas service agreements, okay, which is basically industry of gas and LNG. So revenue certainty is high and risk to the project is low or medium. Because of course PPAs are the best because there everything is guaranteed. Whereas the gas projects, revenue certainty is high, not very high, and risk is also comparatively low. Then take or pay. So there is another agreement which is called take or pay, okay, where it is used either you take or you pay. If you take, you will be charged a certain amount, okay. Sometimes you don't take, okay. Then you have to pay some amount, some fixed amount to cover the project fixed cost. So that's called the take and pay. So we'll understand it more deeply, or you can ask AI to explain you what is take and pay. Okay? So there are some projects which are designed on take or pay basis, okay. Maybe in some other countries like Philippines and other thing, and maybe in India also they're being used, where the same like thermal powers or other kinds of this thing, where the discoms will either they will take the entire production. If they're not able to, they pay a certain amount which takes care of the running cost of the plant. But if they buy the power, then they have to pay the full price, okay. So then the tolling, which is used for energy, which is like off-take mining, then water power agreements, which is basically in a water industry where the revenue certainty is high and project risk is low. So this is okay. So off-taker agreement. So this is again we have done. So this is again a summary. So just I'm putting a slide. You can just read it in your mind, and so it is like this. Okay. So the sponsors, they form the SPV and they run the business. Their job is to bring in equity. They are responsible for developing the project, providing equity contribution, and a strategic oversight of the project. Then the special purpose vehicle is a part of this, floated by the company. A separate legal entity that owns the project, enters into all the contracts, and ring fences the project risk and cash flows. Okay, fine. The lenders, they provide the debt financing and rely on the project's cash flows and security package for repayment. Okay, so the lenders are going to provide the debt, and the debt is repaid from the cash flows generated by the project. Then we have the government, another stakeholder, or the granting authority. Normally it's the government itself, or it can be even a private large company. So grants, concessions, okay, fine. Licenses, approvals, and may provide subsidies or guarantees. So this is the job of the government to help the project to this thing. So they provide concessions, okay. They give you, like a company makes a road, and then the company says, okay, you collect the toll for next 5 years to get back your cost of so that is the concession which the government has given to you, that you own the road for next 15 years, okay. The road belongs to the government, but they give you concession, okay. Then the EPC contractors designs, procures, and constructs the project under the fixed price and time-bound contracts, okay. Then the O&M contractor operates and maintains the assets to ensure performance and long-term cash flow stability. Is that okay? So O&M is going to provide and maintains the plants, equipment, and they assure that there is a long-term cash flow stability. The off-takers, who are the customers, purchase the project's output, for example, electricity, gas, water, under long-term contracts. Advisors, now they can be legal advisors, financial advisors, technical and legal advisors. So somebody is going to do the technical study, feasibility, and the financial advisors are going to give loan or tell you about that, and legal advisors, they support structuring and due diligence and documentation. So they structure your loans and provide a due diligence. They carry out a due diligence before the lenders can give the money. So if the company says that we have got the due diligence done by our legal advisors and this is the report, so the lenders feel at ease that the company is whatever has been stated to the lenders, they actually reflect the assets. They own by the assets are owned by the SPVs. Okay, and this is the amount of power they are going to produce. This is the money they are going to generate. So all the informations are given, and there is a complete due diligence done by the financial and the legal due diligence. Okay, so what I'll do now, I'll just go to the project which we did, okay, the REWA, and then we come back to this. How much time is left? कितने बजे तक? 1:15 तक है ना? Okay. When we do theory part ना, तो we get little bit taxed. Practical में अभी जब करेंगे, and we'll give you projects and you can just do that. So it will be more interesting. Okay. So let's do this case study a little bit detailed. The next 10-15 minutes. So a large, just read it.
Large project finance. Now let us look at the real world example of large project finance. The REWA Ultra Mega Solar Power Project in Madhya Pradesh.
Okay, so this is a solar plant. Okay.
REWA Ultra Mega Solar Limited, commonly known as RUMSL, was formed in July 2015 as a joint venture between SECI and Madhya Pradesh Urja Vikas Nigam Limited.
Okay, so I think we will just come out of this. We'll just go to the screen up. Okay, refresh our minds. Come back to this thing. So let's go to the EPC contractor, which is Larsen Tubro. So this is the Larsen Tubro. Is that okay? So this is a company which is 12th largest company in India in terms of market cap. Okay, and growing at almost 22-23% growth in terms of earning. Okay, as we saw it in the analyst forecast. And currently it is trading at 35.7, slightly above its median average, but it is justified because of a very high growth. Okay, the growth is going to be around 24% in profits based on the PEG ratio which is given here, which is 1.56. When we back calculated, it came 24%. We checked the trading view, view various analysts. The average growth is around 23-24% in terms of EPS. Okay, now. The stock PE ratio 35.7. Okay, now if you look at the formula, would be earning per share EPS divided by market price 4162 divided by EPS. Okay, so if we just use this calculator, let's see. So we have 4162. So we are just trying to calculate what is the ratio given and how it has been calculated. Little bit of it. Okay, there will be some mismatches. Okay, and there are some reasons for it. Okay, I'll tell you that. So divided by how much? What was the earning per share? 119. 119. So this should be the PE ratio. Okay, P ratio comes to how much? 35.7 given by the screener, you're getting here 34.97, almost similar. Okay, fine. So there's some difference. So why the difference is there? For that, though I'm not going to take you to the differences, but I'm just going to talk about. Go to the profit loss account. Okay, the profit loss account. First of all, this is the profit loss account of the company for the last 2014 till 2025, and then there is a TTM number at the end. What is the TTM number? Please raise your hand and tell me, just anyone. What does TTM stand for?
Trailing 12 months.
Trailing 12 months. But why others were not knowing it? First time you are seeing it? Okay, fine. So he is knowing it because he has some, kind of a research which he has done. So, what happens is that this is very interesting. Every quarter the company is supposed to, announce their results. Like, December quarter is finished. Now we are in the month of January. So by 15th of February, the companies are supposed, all the listed companies are supposed to announce their results. Okay? And so far, 2 quarter results have been announced. April, May, June, July, August, September. October, November, December will be announced by February 2026. So 2 quarter results have been announced. So in a year we have 4 quarters. Okay, so if we take the 2 present quarters which the results have been announced and add the 2 last year quarters, okay, and add them, it is called TTM, trailing 12 months. That means last 12 months performance of the company. Okay, so you look at the TTM, the sales was, TTM is 2,70,000. So that means the company is growing. In the next 2 quarters, the company has done a good sales, and the previous 2 quarters have been added to it. Okay, how we have arrived? I'll just show you that. So go to the quarters 1. Go to the quarters profit loss account. This is the September and June quarter. The company's sales have been announced. So you just add all these 4 quarters. All these 4 quarters. Sorry. All these 4 quarters you just add up. This will become the TTM number. Okay, because you want to know how the company is doing currently. So far, what has been announced, declared, and which is available in the public domain, how the company is moving. Is the company progressing? Is the company generating higher growth? So we look at the 12 months, trailing 12 months. Is that okay? So how it has been arrived? You add them up. This will be equivalent to the full year figure of here, TTM. So company's sale is growing. As you know that it is going from 85,000 crores to 91,000, and now it has become 2,70,000. So trailing 12 months number. Is it clear to everyone? Okay. So all the numbers have been done like this. So the company's net profit is also growing. So company made a profit of 17,000 crores in the last full year. In this year, the current 2 quarters and the last 2 quarters of the previous year, it added together, we are generating 19,000 crores of profit for the company. And company's EPS is also growing, isn't it? 119. And the P ratio, which has been showing on the chart on the front, is the trailing P ratio. There are 3 kinds of P ratios. Do you know that? What are those? Aditi? Idea? No. Okay. So one is called, the P ratio. Important for all of you as a finance student, you must know it. If you don't know, now please understand. Current P ratio. Okay, so there are 3 kinds of P ratio. Normally we look at the trailing P ratio. What is given on the screen is a trailing P ratio. Cursor कहाँ गया? Here. So this 35.7 is the trailing P ratio. This is the latest P ratio of the company based on the results which the company has announced. So if you want to know how the company is being currently valued, it is based on the last 12 months, earning per share. The NPS is the current, and EPS is the trailing 12 months. Okay, fine. Okay. Now the current P ratio is basically the market price per share, which is the current one, which is 4,000, divided by the last reported published accounts of the company up to March. Okay, March का EPS कितना था वो और divide करो current market price है, so we get the current P ratio, which is no use to us. Okay, that is already gone. For an investor, for anybody who wants to know how the company is performing, he is more interested to know how the company is going to do in future. Then we calculate what is the forward P ratio, which is taking the current market price per share divided by the next year's earnings per share given by the analyst, the average EPS. Okay, to find out whether the company is overvalued or not. This is one of the job. If the company looks to be very overvalued today, but based on what the company is going to earn next year, because when we buy the shares, when we look for the company, we are buying for future. Okay, if we expect the company's share to double next year, so the current market P ratio will also go up, because people are factoring the next year's growth today itself and pushing the company. The P ratio looks elevated because the next year the company is going to announce 100% growth in the EPS. Suppose, I'm just giving a wild example. So if you calculate the forward P ratio, you'll come to know the company looks to be okay. ज़्यादा valuation जो दिख रही है, that is based because the company is going to do a very good performance next year, and people are buying the share price and pushing up the P ratio. Okay, so it looks to be very expensive, but we calculate way forward down the line, it looks to be good. The other way is to calculate the PEG ratio, where we calculate the future growth in the earning per share and divided by the market price per share, P ratio. So that also gives you almost the same kind of phenomenon to find out whether the company is overvalued or undervalued. Is that okay? So P ratio, trailing P ratio and a forward P ratio. The most widely used in our analysis is the trailing P ratio, which has been shown here, which is to assess whether the company is currently overvalued or undervalued. Okay, fine.
So for calculating the PEG ratio, we use the current P ratio.
No, we use not the we use the trailing P. Here we are using only the trailing P ratio for calculating the PEG ratio. That's a very good question. Okay, we don't use the current P ratio. Neither we use the forward P ratio. Forward P ratio is double counting. Okay, fine. So the current P ratio is old phenomena. So we look at the trailing P ratio and divide by the future EPS. The EPS calculate the PEG ratio. Is that okay? Fine. Then we have the book value. So book value will be what? The net worth of the company, or assets minus liability divided by the total number of shares of the company. Is that okay? So the figure is the total number of shares are given at the bottom somewhere. Number of equity shares 138. So what we do simply is we go to the balance sheet, okay, and take this number, the reserves plus the equity, 275 plus 101, and divide by the total number of shares, we'll get the book value. Is that okay? Should we do that? Okay. So we take the calculator, and what we do is 101, 101, 108. Is the figure right? Plus 275. So you get 101,383, and then we divide this by the number given here, which is 138. So what divide over? Let me just see if we're getting the right number. 734. So how much are we getting the book ratio? 737. So we are almost there only. Is that okay? Fine. Then we have the ROE. What is the ROE of the company? 16.6%. And what is the ROCE? 14.5%. So there are two ratios which we look at, which is the ROE is return on equity, and the return on the total capital deployed in the company is 14 point this thing. So if the company is earning how much? 16.6 for the shareholders. It's a good thing, okay? So should be putting your money in a company which is earning at least 15 to 16% ROE. If the company is earning below that amount, 13 is still acceptable. But if it is below that, then normally you don't put money. So the first indicator is the company must earn at least 15% return on the equity. That's the first important aspect to find out if the company is doing well or not. Okay. Now, how do we do that? ROEs will be the net profit of the company divided by the shareholders' capital. So we go to the profit loss account, okay, and take the net profit and divide this by the balance sheet figure of the equity and reserves. We'll get the ROE. I'm not doing it at the moment, but you can do it, okay. Then if you have to calculate the ROC, then what will be doing? You will be taking first, the number will be EBIT. EBIT divided by the total capital of the company. The total capital of the company would be all this. 101, borrowings, you add everything, okay, and take the EBIT from the profit loss account, divide by that, you will get the return on capital employed. Return on capital employed, okay. So there are two numbers, ROCE and ROE, okay. They should be a good number, like 14-15%. Now, ROE is generally has a leverage impact because the ROC includes your loans, borrowings, which generally the cost is lower, and it actually amplifies the ROE in a good times. In bad times, it does just the reverse. We'll talk about that later. Then the debt equity ratio, which is more important. So debt equity ratio is how much? 1.32. What does it mean? That for each 1 rupee of equity, there is a 1 rupee 32 paisa of debt. So company is not only using its own money, it's deploying the capital taken from loans also. Okay. So if you look at the balance sheet of the company, we will find the company has a loan of 1 crore 34 lakhs. Okay. Against the equity of just 1 crore 1 lakh something. So if you divide 134 divided by 101, we will get the debt equity ratio. Is that okay? Fine. So now you can just look at, the most of the companies, they would like to have, only the companies which are big companies, which require a lot of money, they have to play with debt. Otherwise, there are many companies which are having a zero loans, okay? They don't take loans. Their debt coverage ratio is debt equity ratio is very good. But some companies have to take loans because if they have to grow more, so they need more money, so they have to take more loans. For example, let's go to Reliance and see. So Reliance, what is debt equity ratio? 0.43. So very good. So they have not taken any much of loans. But if you go to the balance sheet, they have taken huge loans. They have 3,74,000 crores of loans, more than L&T. But the equity is 8 crore 63 lakhs. Their own contribution coming from the shareholder is very high, but their portion of loan is very less. Okay. So they had originally very high loan in March 23, 4 lakh, but they have reduced it to 3 lakh 64. Brought their debt equity ratio to a much lower limit. Okay. But okay, I'll come to the ROE because the company of ROE is just 8.4%. It's a very poor ROE of Reliance. Okay, but still the company is growing and it is a much sought after share in India today, and it has given 27% return in the last year. Okay, we'll talk about that. The most important other one is the interest coverage ratio. Okay, the last one. Interest coverage ratio. Like we have the debt service coverage ratio, where we take the total cash flow generated by the company divided by the interest plus the loan principal. Here we take the EBIT divided by interest. EBIT divided by interest. Okay. So it is 5.39. Okay. And let's go to Larsen Toubro and see how much they are doing it. There it is 3.54. So the higher this ratio, better it is. The company is doing very well. It can manage its loans very well. Even if the profit goes down, it is earning 3.5 times more than the operating profit of the company, which is the EBIT. Is that okay? Fine. So there the interest coverage ratio is 3.54, but Reliance is having a much better coverage ratio. Okay. Let's look for another company. Okay. For example, companies like Infosys. They don't have much of debt. Okay. So interest cover ratio is 95 times because they don't take much loan because they don't require money. Okay, they are not like Reliance or L&T. Okay, and their debt equity ratio is 0.08 only, very low. Okay, fine. So let's go back to one more thing. Please. We are going to, coming to the end now.
आशीष, अक्सू, अतीत, आयुष्मान,